It's five, Gaurav.
Hello, everyone, and welcome to an exciting panel discussion on iFAST Advisor Insight. I am Rachna Makhija, Senior Research Analyst with iFAST Financial India Private Limited. I'll be your moderator in today's discussion on ETFs moving from hype to high impact. Before we get into the crux of the discussion with our advisors and panelists, I will just highlight a few quick points from my side. In the global context, the AUM in the ETFs has touched $8.3 trillion, dollars, with 66% being contributed by US alone. In India, too, the interest in the ETFs has seen a rapid surge, growing almost 17 times in the last 5 years. Interestingly, in the last 1 year, despite the pandemic, the AUM in ETFs has risen almost 87% in the last year on absolute basis. So, despite the dizzy rise in the ETFs in India, we believe there is a lot more to be done before ETF as a product can become a core part of every investor's portfolio along with active funds. From investors' education to deeper, more liquid markets. What more an Indian ETF industry should do to move ETFs into every portfolio? That's exactly what we discussed today with our advisors and panelists, sharing their views to maximize their impact of the ETFs in investors' portfolio. Importantly, we also discuss what will be industry's next moves in this space as a product would be. So, to start off with this discussion, I would like to first welcome our advisor, Mr. Rajesh Chheda. He started off with the financial markets very early. In fact, around 1990s, I believe that time the Sensex was nearly at 1,000 levels. He has been a part of the transformation of the advisory business itself. He is a certified financial planner and a registered investment advisor and focuses on later life planning solutions. Welcome, Rajesh, to the event. Our next advisor is Mr. Jayant Nanjappa. He is an investment strategy with the 9010 Financial Planners. He is a CFP. Jayant uses his deep interest in high finance and economic to assist his clients for smarter investment decisions. Happy to have both of you. We can start the session. So, Rajesh, you have had a long journey in the markets. So, do you think the investors' understanding and acceptance of ETF has improved over the years?
Uh, Thank you, Rachna, for your kind introduction. Before coming to the investors, let me share my understanding and acceptance.
Yes.
Yes, it has improved, but very slowly and cautiously. I would say ahead of its time syndrome. But investors' understanding would be a function of the advisor's understanding, I may add, and the last few years' growth will appear insignificant if it is extrapolated into the corresponding future years. That is what I would suggest. Over to you, Rachna.
Okay, sure. Thanks, Rajesh. Jayant, what's your experience like?
Thanks for the invite. So our experience is good and as well as bad. So back in time when we started way back in 2009-10, so we were actively looking for other asset classes as a portfolio strategy. And for a surprise, like in a buffet, there was only one dish, and equity was only game in town, and we had a little bit of debt. So we looked towards ETF for a first allocation towards gold. So I think gold Bs started way back in 2007 March, I suppose. And at that point of time, there were two or three ETFs in gold, and that's how which has got us into the whole experience of getting into the ETF world. And gold Bs led us to Nifty Bs and then Bank Bs. So that's how we initially started a whole allocation towards ETF side of the instruments.
Okay, sure. So, Jayant, okay, with more of ETFs being launched into the market, what more needs to be done to educate investors for ETF as a product?
Yeah. So coming to the variety part of the thing, so bear with me for some numbers. So if you look at US, the mecca of financial markets, So there's around 4,000 companies listed in US. They have around 28,499 funds, and out of which around 2,028 is the ETF side of the thing. So for an asset size of almost around $7 to $8 trillion in a whole larger scheme of things, there is so much of variety of there. In fact, it's problem of choices out there in terms of what to choose and what not to. Coming back to India here, so we have again 6,000 plus companies listed, 1,500 actively traded companies in the whole market, and we just hit 100 ETFs in this April in terms, and so that's in terms of number of ETFs. In terms of the assets, if you see, it has grown almost around 37 to 38 billion dollars, and in the last 7 to 8 years, it has almost had a CAGR growth of almost around 65 to 70%. So thanks to the previous regime and the current regime in terms of setting up the whole base of taking the hockey stick growth of J curve in terms of how the assets have grown. And that is to do with the numbers. And if you look at the overall allocation, where does the allocation come from? So top 30 cities contribute almost around 85 to 90% of the overall money, and the next B30 contributes only 10% of things. In terms of overall allocation, if you see, the institutional side of things contribute around 91%. So here again, institutional is quasi retail money, and direct retail is around 8 to 9% in terms of the overall. So that is where I think the more depth needs to be bought into the market, where you get the common people in terms of how to do the allocation. See, for a common retail guy, these topics, whether active, passive, ETF, mutual funds, is all foreign topic. He will have no idea whatsoever in terms of how he needs to do. So it is our role in terms of financial planners, allocators, distributors, wealth managers to get them into in terms of these instruments and try to manage their wealth. And no time better than now, when Demat accounts are added 15, 20 lakhs every month, and everyone is interested in the market and it's at the peak. It's no better time to handhold them and offer them into bring them into the fold of investing, and why not ETF?
Yes, that's really interesting. So this question is for both of you. ETFs are known for their efficiency in terms of the cost and the performance. So do you think this impact can be sizable enough from retail portfolios?
Yeah. So, Rachna, with the cascading downtrends of costs everywhere, thanks to technology, on paper at least, say an index ETF's cost is super low. And yes, probably one could replace a client's index allocation, I would say. So this is my take.
Okay, so actually, how are you using ETFs as a part of investors' portfolio allocation strategy, Jayant?
Yeah, so ETFs in terms of simplicity, transparency, cost, everywhere, it ticks the box in terms of the thing. So in fact, some of the ETFs are way cheaper compared to our big brothers in the West in terms of the US, if you compare the things in terms of the cost. So there the assets came first, then the cost went down. Here the cost went down and the assets are started building up. So in terms of getting people into the fold of retail, obviously, I mean, it does, if you track and allocate and construct a pretty decent portfolio, I think large chunk of assets which can be allocated to a retail portfolio, provided that you make the retail guys understand the whole concept of what they're getting into. And the only area where at least locally we are lacking is in terms of the liquidity per se in terms of things. So ETF is nothing but a portfolio of stocks. And in terms of the West in US, if you see the spread, the ask and bid price in ETF is so narrow. I mean, you don't even get that margin when you trade in direct stocks. So because of the market makers and all the technology and the efficiency of the things which is there. So if those things can be replicated here, and I don't see why it shouldn't be large chunk of portfolio in terms of managing. And you do have variety of things which is already in there. So you can replicate across all the benchmarks, which is there, large cap, mid cap, small cap, and things. You have even liquid and debt. So I think liquid, which was launched way back in time, I think Samir can throw in light on how his journey at benchmark, the whole thing started. The only thing which we look as an option is to have more multi-asset strategies in ETF, and of course we look into the active side of the things also in terms when it comes to ETF, which is very famous, at least in last 4-5 years in US. The Cathy Woods of ARCs of the world have disrupted the whole mutual fund and the hedge funds of the thing. So why can't we have similar strategies in India, which we can allocate and things? So yes, we do look at these things in terms of allocation through factor investing, benchmark investing, international allocation and all. So these are the things which I see that if the liquidity and how you implement the whole things in terms per se of ease of implementation, how do you execute the things in an advisory model? If things are more normalized with use of technology, I don't see why ETF shouldn't be a large chunk of the pie in the retail wallet.
Yeah, I'm sure India has a long way to go and there's a good scope in this industry. So thank you, gentlemen, for setting the context of today's discussion. It's time to bring on our esteemed panelist from the mutual fund industry, Mr. Samir Desai, National Head ETF with Nippon Mutual Fund, and Mr. Siddharth Srivastava, a Head in ETF products with Mirai Asset Management Company. It's my honor to have both of you in our session today.
Thank you, Rachna. Thank you for inviting us.
Thank you. So let me start with you, Samir. So despite the recent surge in the ETF AUM, would you still believe that our ETF are at the beginning of the tryst? And what are your thoughts as to why, still it's like ETF are driven by institutional investors, as Mr. Nanjappa suggested, that 91% of the industry is being dominated by the institutional investors. So please share your thoughts on this.
Yeah, so thank you, Rachna. I think it's a, wrong notion that most of the, industry is dominated by institutional investors. Certainly, as far as AUM is concerned, the institutions have a lion's share of the ETF pie. But we have to look at another very important data point, which is the number of investors. So, for example, last year, that is FY21, the industry size in terms of number of investors has gone up from 2.4 million to 5.5 million. I can, share Nippon's numbers. For example, Nippon has added almost 1.4 million ETF investors if I include the government business, which is the CPSE ETF. If I exclude the government business, which is the CPSE ETF, even then we have added about 0.93 million investors, which is a large number. Also, let me talk about another data point, the volumes on the exchanges. So let's take the example of Nifty Bees, which is the oldest ETF in India, which was launched by Benchmark in December 2001. Now, Nifty Bees for the longest time period used to have a daily average volume of 1 or 2 crores. And the day it hit that, we used to be very happy, which was some years back. Today, Nifty Bees, and I'm quoting the NSE numbers, the daily average volume over the last 1 year is 28 crores. Okay, this is the daily average volume over the last 1 year. If I take the first 3 months of this calendar year, January to March, the daily average volume is 37 crores. Okay, so this shows the ever increasing acceptability of ETFs amongst the retail investors. So whether it's the number of investors, the trading volume, I think very important thing that I increasingly find, all categories of investors, including retail, are beginning to understand that simplest way to start your asset allocation, let's say, for example, in equities, is to buy a Nifty 50 and a Next 50 ETF. So you have the Nifty 50 stock of the nation and its younger brother, the Nifty Next 50. Okay, at least if you do this, you are going to get the market average rate of return, whatever it is going forward, because that is the only consistent return that one can capture, which is the index rate of return. When you go into alternative strategies like active strategies, you will either outperform the index or underperform the index. So I always say that the index is at a silver medal position. You are doing away with the underperformance. Okay, you are guaranteed that you will never underperform. Outperformance is anyway a random event. Okay, you don't know whether you will outperform or not. So you may not be at the gold medal, but you will definitely never be at the bronze medal position. You will always be a silver medalist when you invest into an index ETF. And also, the ecosystem which is changing and which is increasing the efficiency, especially for retail investors, is platforms like, the large, digital platforms offering, for example, facilities like the do-it-yourself SIP into ETFs. See, this is a very popular concept. Then you have small cases constructed out of ETFs. So ETF baskets comprising of equity ETFs, fixed income ETFs, commodity ETFs, ready-made asset allocation portfolios being offered to retail investors also, which is like a ready mix, basket of various ETFs. So you don't have to break your head over asset allocation. You don't have to figure out, which, how to rebalance, etc. This is a ready-made facility which is available. So I think this is, going to go, it's going to, evolve going forward. So I already see the ecosystem, in a different trajectory. And this is going to be, even more intense going forward.
Okay, sure. Siddharth, can you please share your views on the same, please?
No, I'll echo what Samir just said. So I think while we all know that a lot of AUM is coming from ETF, so a lot of traction is there in the ETFs which have some sort of government mandate. And then if we remove all that and look at the AUM, it's still small where we expect it to be. Volumes, while Samir has mentioned that it has grown so much, but we still want more volumes to come, bid ask to spread to reduce, more volumes for all the ETFs, not just the popular ones, for sectoral ETFs, for thematic ETFs to happen. I think that will eventually happen. A lot of things are working in favor of ETF market right now. You can talk about the increase in the number of demat accounts, which we have seen. Samir mentioned about small cases. I think model portfolio using ETFs is a way forward, right? But I think with more AMCs getting more serious in ETF business, more products coming out, I think what is also required is probably more sophisticated authorized participants, market maker to also come uh, in the ETF market, so that I think one concern typically which retail investors have is around the liquidity and whether he or she is able to buy it at the right prices at all times or not. I think once the ecosystems develop more, and I think it will develop, we have seen taken a very significant strides in 3 4 years. I'm like 2 years back, no would have imagined debt ETFs coming up in such a big manner, but they are doing it right now. It's happening right now. So I think foundation is laid, and I think eventually in coming years only you'll see a very significant shift towards both towards AUM growth in other ETFs also, as well as the liquidity on the exchange.
That's really insightful and a wonderful start, Samir and Siddharth. So I believe Jayant has a follow-up question to this.
Yeah, so both to Samir and Siddharth. So what are the factors in terms of as a strategy of as an industry as well as individually as a firm of you guys are focusing on to improve the efficiency and to introduce newer investors in retail categories? So probably Samir can go first and then Siddharth.
Yeah, okay. So, a couple of things which I said earlier, Jayant. So one is, of course, in our case, we are focused on in the passive division on preaching the passive index philosophy, and how it is a very potent strategy, So it's as good as saying, let the market be your fund manager. Okay, bet on the market portfolio, which is the index. The index is like a national cricket team. Bet on the national cricket team because the national cricket team is always going to be there. Okay, so that's a conscious effort of talking about why passive is a potent investment strategy. I think that leads to a virtuous cycle as people understand the advantages of going passive, low cost, doing away with the guesswork of stock selection, manager selection, all those non-systematic risks, that brings in more investors, which leads to higher volumes, which is what we are seeing in our case. And it's not only for our Nifty ETF, but for a couple of ETFs, we see very high volumes. Then the another component of the efficiency is also to provide more and more building blocks in the passive space. So whether it is your broad market products, whether it is your sectoral products, fixed income ETFs, and commodity ETFs. So asset allocation becomes very, very meaningful, because I believe that asset allocation can be practiced only using passive portfolios, logically practiced, because indexes are the best representation of an asset class. They capture the properties, characteristics, and behavior of an asset class, which I think no other alternative strategy can ever do. So the conscious strategy of Nippon, for example, is also to provide as many building blocks as possible on the passive side for meaningful portfolio construction. So I think what we are trying to achieve, and I think what a lot of retail investors are understanding, I will use the words of Dr. Paul Samuelson to describe that. Dr. Samuelson once said, investment should be dull and boring, like watching the grass grow and the paint dry. If you want excitement, go to Las Vegas. So what Dr. Samuelson was saying was, put your money in the index. Okay, it is dull and boring, but that is what works. So I think this is being understood by investors, and that is what we are seeing in the number of investors that are increasingly coming towards or flocking towards ETFs.
Yes, I think Dr. Samuelson was one of the inspiration for Vanguard to start the entire rejig of
right.
US in terms of disrupting the investment world. So
That's
that's your, what is your firm strategy in terms of getting more retail into the fold of ETF side of the business?
So apart from the fact which Samir rightly mentioned, that we need to have building blocks, right? If we look globally, also model portfolios doing asset allocation using multiple ETFs, it's a large cap sector, thematic ETFs, is something which is very prominent. I think same thing. I think a lot of AMCs are trying to do, including us, putting the right building blocks in place. But apart from that, we are also focusing on, I'm sure that Nippon already does, is that first of all, in our case, we have appointed our own sister concern as a market maker on the exchange, just to ensure that we have control over the bid-ask spread on the liquidity in a much more stronger manner. So that I think that is one complaint which we typically get from the retail investors. While Nippon comes with a lot of legacy, new players like us would like to typically have the liquidity at the right prices on the exchange. Secondly, also we have focusing a lot on the operational aspects, because while we understand that there are 100 products, 100 plus products now in the ETF market, we want the investor to get the right experience while buying or selling ETFs. Because the first thing when we talk to a fresh investor, there's always a concern around the liquidity, and that is what we are addressing a lot. And second, I think from our side right now, we are doing a lot of IPs, lot of videos, lot of investor education, because unlike a mutual fund where people know how to invest, a lot of people don't know how to buy or sell or transact an ETF in a manner which will be beneficial to the investor. Let's say, for example, using a limit price instead of a market price, checking the INAV before placing the order. So we are focusing on very basics, apart from setting up the back end and focusing on the operational aspect.
Thank you, Siddharth and Samir. So our next question is for Samir. I'll start with you. So thematic ETF we have seen a lot of thematic ETFs being launched. So do you think that their concentrated exposure makes them more riskier? One, and also should investor use this as a part of their tactical allocation in the investor's portfolio?
Yeah, so Rachna, see, I would look at it this way, that apart from your gap-weighted broad market ETFs, which to me is like, drinking plain water, you have thematic ETFs and sector ETFs. So there are two things. So sector ETFs, definitely important sectors like IT, pharma, bank, these are important ETFs. So for example, currently we have the Nifty Pharma ETF, NFO, underperform, one of the thought processes that goes into providing these sector ETFs is the low correlation to the broad markets. Okay, so it's very important to combine low or negatively correlated products to do efficient asset allocation. And the thematic ETFs are, more of the smart beta ETFs, where the beta is kind of, you use certain factors to deviate from the cap weights and try to make it smart. Now, there are actually two views on this in the West. If you listen to certain, economists like the famous Dr. Burton Malkiel from Princeton University, he says beta is beta. It is neither smart or dumb. Okay, so it's beta. But certain factors can be used to give a tilt to try and generate what we call alpha over your traditional cap weighted beta. So our philosophy is that such products should be used in the satellite component of the portfolio. The core component of the portfolio should be in your broad market, because thematic ETFs, whatever the factors that are used, can tend to outperform or underperform the broad market ETFs. So combine it, if at all, somebody wants to do it with your traditional cap weighted products in a kind of a core and satellite combination. So this is the way we look at this sector and the thematic ETFs.
Okay, sure. Siddharth, can you share your thoughts on these?
Yeah, so I think that's a fair question. But I feel that while a lot of sectoral ETFs and thematic ETFs in India might be concentrated, but that reflects the reality of the sector. You're looking at banking ETF concentrated, financial services sector index concentrated, but then those 10, 12, 20 stocks probably capture the almost 80-90% of the concerned sector. So that is what the sector is. The beauty of the index investing through ETF is that you know the methodology, you know the portfolio on a daily basis, and that is why investor, whenever he invests in sectoral thematic ETFs, he first needs to understand what the objective of the ETF is, what the portfolio of the ETF is, and whether that aligns with his investment objective or not. I think, as Samir mentioned rightly, that these sector and thematic ETF can play a huge role in your tactical allocation in your satellite portfolio. For example, a year back, when banks weren't doing well and markets were recovering, you could have probably taken an exposure if you wanted in a banking ETF in a tactical manner, probably. So different sectors, different themes probably have different cycles, and depending on those cycles, people take those bets. And when you're taking those bets, typically you are taking the risk to the concerned sector as well as the theme. Portfolio, whether the portfolio is 15 stocks, 20 stocks, as long as it captures the essence of the sector and theme, I don't think it's a problem. Problem is more to understand whether the bet which you are making on the sector or on the theme is right or not.
Okay.
Thanks.
Yeah, and continuing with Siddharth, partly you've touched on that, but what I had a question was, debt ETFs seem to be gaining traction. So do you think the Indian debt market has the required depth and liquidity to support the various categories of ETFs that we are seeing today? And what are some of the challenges advisors and distributors should bear in mind in this regard?
So I think Samir Nippon has an existing debt product. So probably Samir can take that question and then I'll add on my opinion.
Either ways,
Yeah,
absolutely.
sure. So see, debt is obviously, Rajesh, an important part of the asset allocation. So it's negatively or low correlation to equities. So it is important. Now, honestly, yes, the debt market is not as liquid as the equity market. It's more of an OTC market in India. So obviously, the liquidity will not be as good as the equity ETFs. But what we have seen is, and that is why consciously the products that we have launched, have addressed some of that concerns. We think that the SDL market, so a lot of our debt ETFs have the SDL instruments, where the credit risk is sovereign, so that part is addressed. And also the liquidity part is much better as compared to the corporate bond markets. So the ETFs that we have currently on the fixed income side, apart from your GSEC ETFs, is the SDL CPSE bond combination, or a pure SDL combination, or a pure SDL portfolio. So that, is definitely, much better as far as the liquidity is concerned. And we have seen that it's not as challenging as the bond market.
Okay,
Yeah,
Siddharth, now
yeah.
over to
Just
you.
to add to what Samir is saying, so I think in debt ETF, we are especially seeing. You rightly mentioned there's a lot of concern around liquidity of the underlying bond market itself. So that's why you're typically seeing that AMCs, and including us also, we are thinking about uh, a portfolio consisting of, let's say, SDLs, PSU, AAA, corporates, and a GSEC, where we can still find liquidity in the secondary market, and we can manage the ETF in a better manner with lower tracking error, where there's as less liquidity as possible. So I think eventually in the start, people will approach the debt ETF market like that. Probably have, as Samir mentioned, SDL and GSEC and AAA rated papers in the portfolio, and not venture into, let's say, AA or take higher credit risk, take a higher credit risk portfolio. But I think for the investor, it's a very good opportunity, right? There were a lot of concerns around the transparency on what sort of portfolios investors taking exposure in when he or she was investing in the active mutual fund. That is completely taken away right now. In ETFs, you get a complete transparency what sort of portfolio you're investing in. Secondly, I think there is now option between a fixed maturity investments. Typically, that is only there on the G6 side, or a target maturity based debt ETF, where you can just use an ETF, probably like an FMP, and get the returns based on the yields. I think what investors should ideally again focus on, as you mentioned, for all the ETFs, are two things. One is obviously you buy and sell on the exchange, knowing what is the approximate right price of the ETF based on the real time net asset value. And secondly, in case of debt ETFs, probably be cognizant of the fact that the yield, there's a BlackRock study which is out, which talks about that the target maturity based ETF typically in the end gives you a return which is plus minus 20 basis point from what the yield at which the investor invested in. So I think there were a lot of questions which were raised. I think so that's why it's important to mention that also, while we have not seen any target maturity based ETF maturing in India, but that sort of expectation alignment is also necessary when it comes to investing in debt ETFs, at least on the target maturity.
So, what are your thoughts, Siddharth? I would like to start this question with you. What are your thoughts on using ETFs for global investing, and what could be the benefits for doing so?
So I think that's a very uh, I think a simple question to answer, because see, there are multiple advantages. First of all, typically when we invest in global markets, we talk about developed markets, right? And there the markets have become very efficient. It is difficult for active fund managers to outperform, let's say, S&P 500 or a Nasdaq 100 on a consistent basis, and SPIVA report and every report out there, data talks about that. So the benefit of doing global investing through ETFs is first that you are getting a beta exposure, and exposure, getting returns which active funds are finding difficult to perform. You're getting that returns at a very low cost. Typically, the ETF, for example, the ETF which we have, which provide global exposure, is at 38 basis point. There are ETFs less than 1% the market. So you're getting that at a very low cost. Secondly, people appreciate the kind of transparency and a rule-based approach which ETFs bring out, especially in case of global markets, because people understanding regarding the global market is less. So they in fact appreciate the familiarity which an index, which an ETF investing brings to investing when it comes to global markets.
Okay, sure. Samir, would you like to please share thoughts on this?
Yeah, so eventually, Rachna, the asset allocation principle has to move from local to global. Okay, so you have to have the global beta, as Siddharth rightly mentioned. Some allocation has to be there to the global betas. because finally you are investing in global enterprise. You're buying capitalism in the aggregate, as the way I see it. Uh, our experience, of the past, and so we are consciously addressing this fact. So if we have to go for a passive strategy on the global front, then we would prefer the index fund format to the ETF format, because we find that the index fund format is probably uh, more efficient as far as the global indices are concerned, uh, because it does away with some of the challenges of real-time pricing, etc., which an ETF may face on the global side. So that's the thought process, within our team at present.
Okay, sure. So Siddharth, one question that comes to my mind here is, how do you manage the real-time pricing in case of global ETFs?
So that gets a bit technical. So it's not as simple as you do it for let's say Nifty 50 or Next 50, where at that point in time the underlying stocks are trading, and you simply have to use those prices to compute the real time INAV of the ETF. In case of global ETFs, how it works is that, for example, in case of Nasdaq 100 or a FANG Plus, which we have. Uh, what we do is we use the previously declared NAV as a base. So let's say yesterday's NAV was rupees 50. There are a couple of things which may change after the US market has closed yesterday. And today, let's say at 12 o'clock, when I'm trying to find out a real time net asset value. One thing which has changed is currency market, right? INAM could have depreciated or appreciated. Second thing which could have changed, which we get as an indication, is that, like in India, we use SGX Nifty futures to gauge at what levels the Indian market will open, right?
Yes.
Similarly, we use Nasdaq 100 futures or a FANG Plus futures, which trade during Indian market hours also, as a gauge at what is the, let's say, expect in the movement in the futures market. And we add these two components,
Okay.
and that is how an approximate fair value of the ETFs derived. So, for example, let's say the INR depreciated by 1% and the futures is up by 1%, then 50, which was the NAV yesterday, will add 1% because INR depreciation adds to the value, and then you'll add 1% because the forex futures have moved up, and that will be the roughly INAV around 51 for the ETF unit at let's say 12 noon. And that is how you track it, and you keep on updating the NAV on almost a real time basis.
That was really insightful. My next question is for Samir. I'll start with you this time. So, can you share your any more exciting ETF ideas that you are following? If yes, then you could share some interesting updates from Nippon side.
So currently we are, we have the Nifty Pharma ETF NFO, which is on, which we think is another meaningful and important sector over and above the IT and bank ETFs that we already have. So this is the current, it has low correlation to your broad market indices. That's the thought that goes into launching the various sector products. We obviously are looking at the international space, and we will be coming out with some international funds too in the near future. And we will continue to, on both fixed income side and the equity side, we will continue to add meaningful building blocks to provide, abundant, options to advisors, RIAs, and all intermediaries and investors to do pure passive portfolio construction. So that's the whole thought process.
Sure. Would you like to add your ideas from Mirai's side?
Yeah, so I think we are fairly new in the ETF side of things, almost less than 3 years. So probably what we are doing is we are following a barbell approach, having few plain vanilla ETFs which are missing in our stable. Uh, Launch those products if we are finding some appetite in those products. I think, and there's a good competition already in the market for those products. But apart on the exotic side, we are probably focusing more on thematic ETFs, both in India and and globally also. So probably our line of thinking is more so towards the ETF as well as the fund of funds to in the passive space, and we will do some very few plain vanilla ETFs where we feel that we can build some, provide some competency and probably focus more on the thematic side, both on the domestic and international investing based on ETFs and the fund of funds.
Sure.
As a passive product for Samir, how should ETFs be combined with active funds to build up the core and tactical allocations of investor portfolios? I mean, you've touched it, but just trying to
Yeah.
reinstate the value. Yeah.
Yeah. So, Rajesh, we clearly believe that the core component of any portfolio should be in the broad market cap-weighted ETFs, because, as I said earlier, the only assured return that as an investor I'm going to get is the index rate of return, whatever it is. Okay, so that's the only assured rate of return. Any active tilts from the index, from the cap weighted index, whether it is through smart beta or through your traditional active strategies, is going to be either at the gold medal position or at the bronze medal position. So you'll either outperform or underperform, which is a random event. Okay, so that's why we say that be with the market. Okay, and when I say that be with the market or let the market be your fund manager, I'm talking about the traditional cap-weighted products. So I think majority of the asset allocation should be with your traditional cap-weighted products. So let me, give you two actual examples. So some of the, let's say the two oldest ETFs in India, the Nifty 50 ETF, which was launched in December 2001, and the Next 50, which was launched in February 2003. The returns so far are, 16% CAGR and about 19% CAGR. Now, in this time period, think of the amount of active strategies that would have come and gone, outperformed, underperformed. But this is the return, as the way I look at it is from India Inc. Both these ETFs represent India Inc. So betting on these ETFs is equivalent of buying Indian enterprise in the aggregate. So I will always say that the core part of the portfolio, whatever that component is, should be in your cap-weighted products. The satellite part of the component can be in any of the active strategies, whether it is smart beta, factor investing, quants, or your traditional, actively managed funds. And I'd also like to add one last, I would like to quote one, American investment advisor and RIA who once said that alpha has always been perishable. But in today's world of instantaneous information, it has the shelf life of unrefrigerated fish. So this has to be kept in mind when you look at alpha. That alpha has the shelf life of unrefrigerated fish. It is transient. It will keep changing hands. So please be mindful of this fact. And that's why beta is the way to go in the core part of the portfolio.
Siddharth?
Completely echo what Samir is saying. If we look at the data, if you look at last 5 calendar years, you will not find a single active mutual fund in large cap category which has been in quartile one in all 5 calendar years. You'll be surprised to know that there is only one fund which was in quartile one in 4 out of 5 calendar years, and that is one of the poor performing large cap fund this year. Every year, 4 out of 7 quartile one large cap funds drop out of quartile one. So not only the question is whether the large cap funds are able to outperform benchmark ETFs, but also the question is how consistent. And the segments of the market where you are finding such efficiency, as Samir mentioned, that their ETF should form part of your core portfolio. In let's say in large cap space, even let's say if you look at BFSI, you'll be surprised to know that 100% of funds are underperforming BF financial services index in last 3, 5, and 7 year period by a margin of almost 4 to 5%. So in segments, in these segments which you identify, which are efficient, which have become efficient, where alpha is not getting generated, take core exposure to ETFs. In segments where you want to, let's say, because of the opportunity, you want to take a tactical exposure, ETFs provide a very low cost medium without an exit loss. to take that exposure, right? To move in, to move out easily. And then the exposure in ETF can be taken in asset classes like gold, right, where you don't have revenue on the active side, and in the global market where I think transparency and low cost and getting the beta returns should be preferred more than anything else. So you have to identify the segments of the market where ETF makes more sense. Some segments of the market, obviously active makes more sense. There probably tactical allocation can be taken by ETF, and that is how you build the portfolio of a client by blending ETFs as well as the actives in the right segments of the market.
That was a wonderful advice from Siddharth and Samir. So this brings us to the end of the detailed question round. Our next round is a rapid fire round. I'll start with Samir this time. So for the equity space, rank large, mid, small cap ETFs in the order of preference.
So on the small cap, there is no ETF in India. There is an index fund available, but definitely the large cap and the mid caps are there. So if I go by the market capitalizations, then clearly the large cap space of comprising of the two ETFs, Nifty and Next 50, is 75% of the M cap roughly, and mid cap 150, would be another, let's say about 12 to 13%. So clearly, I think if I go by the cap weighted ranking, then this is the percentage to follow. But what actually happens is, a lot of investors want to tilt in favor of mid or the next 50 ETF. So they would, increase the asset allocation to that. So I think that is very subjective. What allocation should be done to what ETF. I think depends upon the advisor and the investor. So they have to decide. Our job as a manufacturer is to offer the different building blocks.
Sure. Siddharth, can you share your views on this question, please?
My personal preference order will be large, then mid, and then small. As I mentioned, that large segment is more efficient. Funds are finding difficult to outperform the benchmark. As Samir mentioned, Nifty 50, Next 50, Sensex. I think these are good ETF products where you should take exposure in, and that will be my personal preference. And investor obviously has to look at his or her own risk profile and investment objective to choose where to invest in the ETF category. But my personal preference will be large, then probably mid.
So Samir, this question is for you. For the debt space, please rank medium and long term in the order of priority at this juncture.
So, as Siddharth had, correctly answered, see, on the debt side, we have mostly the target maturity products. Okay, so it's the roll down strategy in a FMP kind of, with FMP kind of characteristics, but in the ETF format. So that is what so the debt space doesn't, really have the duration products. It has the fixed maturity products. Of course, on the GSEC side, we have the constant maturity, 5-year, 10-year products that are available. And of course, the money market ETFs, which are mostly overnight kind of products. So really, there are no, I would say, constant maturity duration products in the ETF space currently.
Yeah. Siddharth, your views, please.
Same, I think we don't have debt product as of now, but if I have to prefer personally, again for myself, I'll probably prefer a medium than a long term as of now. As Samir has already highlighted that whatever target maturity you are seeing is typically in this range itself, and the long term you are seeing a fixed maturities which are there on the offer in the ETF segment. So probably not an apple to apple comparison, but if you exclude everything and just talk in a very plain manner, then probably my personal preference will be right now a medium term than probably a long term.
Sure. So, Siddharth, top 3 things to consider while selecting an ETF.
First of all, I think obviously whether ETF aligns with my investment objective or not. I think the beauty of ETF is that it's very simple and it's transparent. People should take use of that and understand the product before investing. Second is obviously tracking error and tracking difference. Both tells you about how well the ETF is being managed and the cost also involved, because tracking difference will be high in that case. And lastly, and most importantly, which I feel and which all investors should ask is whether or not I am buying the ETF at the right price on the exchange. Because more often than not, we have seen that investors execute prices which is away from the INAV, and their investment experience is not that great. So while tracking error, tracking difference, all those things are theoretical, somewhat practical also, and good to see also. But if you are not able to buy and sell at the right prices, liquidity is not there, then it ruins the entire experience. I think investors should focus on that while selecting the right ETF, apart from the previous two things that I mentioned.
Sure. Samir, your thoughts, please.
Yeah, so I think clearly the three parameters which are very important, and this is, when you have a lot of similar ETFs. So, for example, if I have a lot of similar Nifty 50 ETFs, then how do I select the right Nifty 50 ETF? So, clearly the expense ratio or annualized expense ratio is very important. It should be obviously the lowest. The tracking error obviously has to be low, so you know that the ETF is well managed. But I think the most important parameter is the daily average volume or the liquidity, which tells you the impact cost. So again, to reiterate the number which I had mentioned earlier. So for example, in our Nifty 50 ETF, it is 28 crores is the daily average volume currently. So it has one of the lowest impact in the industry. So clearly the ETF is very liquid. So liquidity is a very, very critical factor for any security which is listed on the exchange.
Sure. Okay. So, Siddharth, this time, one question for you. Active ETFs, do you think that it has a place in India? If yes, then when will we have it?
Yeah, I think this question is coming a lot after Kathy Wood getting sorts of a cult image in global ETF market recently, and the ARC innovation doing too well. I think it's bit soon for India. I think people right now don't. A lot of people right now first need to understand the nuances of a plain vanilla ETF, then gradually progress to sectoral thematic ETFs. I even think right now smart beta is something which requires a lot of understanding on how factor works, which are the different cycles in which let's say momentum perform or a quality perform. I active ETF, while theoretically it sounds good, I think probably it may create more confusion than it may help the market right now. But it's a great idea. I think a lot of people in globally it is doing very well. I think sooner than later we'll probably see active ETFs also if regulators allow it. But I think probably right now it may be a bit sooner for active ETFs to come in India.
Sure. Thanks, Siddharth. Samir, your thoughts on this, please?
Well, personally, I'm not a great fan of active investing. So, I would stick to passive investing. And I think even if so whatever may be happening on the active ETF front, I think if we see the global experience, and I think that's very much what is going to happen in India, or it is happening in India, is if you see the largest, ETFs and funds in abroad, for example, the Vanguard Total Stock Market Index. Okay, it's a $1.2 trillion AUM. Okay, so clearly the traditional cap-weighted products have the largest assets. All other kinds of tilts apart from cap weights, I think, are temporary excitement as I look at it. They have a temporary, thrill, and then as they start underperforming your cap weights, okay, they go out of favor. So while these things will keep coming, I think the traditional cap-weighted products, to quote Jack Bogle, the founder CEO of Vanguard, it will remain the gold standard of investing. Okay, there is nothing that can beat your traditional cap-weighted indexing because it is truly the market representative portfolio.
Sure. So, Samir, one line advice to our investors at this juncture.
So I think investing is all about, doing away with excitement and thrills. It should be dull and boring, to quote Dr. Paul Samuelson again. So dull and boring is the ETF or the index way to go. It is not exciting. It's you simply buy and hold an index, While it may not be exciting, it is, I think, the short way of achieving the long-term financial goals.
Yes. Thank you. Siddharth, one advice from you for our investors at this juncture? Siddharth, you're on mute.
Yeah, my advice will be that active and passive is the way forward. It's not a question of or, it's a answer is and. I think allocation towards ETF will lower the cost of the portfolio, will reduce the active risk, and make portfolio more robust. So advisors should obviously start using it depending on the investor profile. I think active and passive is the way forward in India right now.
Sure. So on that great advice from our expert panelist, we now come to the end of our discussion. I would like to sincerely thank our panelists for generously sharing their time and insights on this interesting topic. I hope this session was equally insightful for all our viewers. Thank you for joining us and stay tuned for our next edition on iFAST Advisor Insights.
Thank you, Rachna. Thank you
Rachna.
for inviting us.
Thank you, Rachna.